Hello, this is Arina Baikova, and this is one of the last videos for Tuesday Teach assignment, week 5. For this video, I chose topic of financial ratios because they help a lot to make informed investment decisions. They are expressed in numbers, so they help to step back and not to make emotional investment decisions. They are easy way to look up at different aspects of the company. So they are just easy, fast, numerical way to express the financial health of the company. Into this video, I'm going to talk about 3 my favorite ratios from traditional finance, and I'm also going to mention several ratios that I used for evaluating blockchain projects. Again, why financial ratios matter? They simplify financial analysis, they compare companies objectively, so numerically, they identify strengths and weaknesses and support investment decisions. Ratio number 1 is price to earning ratio. It's one of the most popular among stock investors. It's calculated by dividing share price to earnings per share, and it measures if the stock of the company is at the moment over-evaluated or under-evaluated. Lower PE may indicate under-valuation. Next 2 ratios are return on equity and debt to equity ratios. So return on equity is calculated by dividing net income to shareholders' equity. It measures how effectively stockholders' money are used to generate profit. So it also evaluates the efficiency of management in the company, and higher return on equity is generally preferred when making an investment. Another debt to equity ratio is calculated by total debt divided by shareholders' equity. It measures financial risk of the company, and if it is low, the DE ratio is low, it may mean the lower risk, but if it is high, it may mean that the company may struggle during economical downturns, so it is more vulnerable to crisis, because even if there's a crisis and they don't have that many clients, they would still need to pay their loans that they have. So this is one of the things to look at. I would also like to mention that none of ratios needs to be used isolated. It's not recommended. It's also important to look at the context of the industry and to compare with competitors, because without all of that, it's very easy to make a wrong evaluation and wrong conclusion and make not a very profitable investment decision. Now let's talk about blockchain ratios, just a couple words. So blockchain projects are not making money the same way as typical projects. So investors are using alternative ratios to evaluate those projects. So first it would be market capitalization to TVL ratio. It represents if the project is overvalued or undervalued at the moment. NVT ratio is showing the network usage. Fully diluted valuation, FDV, and token velocity are a couple more ratios. And generally ratios may also represent investor expectations and long-term sustainability of the project. To sum up, one more time how ratios needs to be used. They should not be used alone. They should not be used without context of the industry. It's better to combine multiple indicators and compare the results with competitors. Again, to conclude, ratios simplify analysis. They support informed financial investment decisions. Blockchain projects require different metrics, and data improves investment decisions, so it helps to make better informed decisions. Thank you for your time and attention, and this is the reference list for this week.